even though still some entering the room. For the sake of those of us who have been early this morning, I suggest we start it. A very good morning, Frankfurt, and our dear guests from 10 countries around the globe. Warm welcome to our 39th Food for Thought. This time, at the first time, in cooperation with the EU Roundtable of Financial Centers. The EU Roundtable consists of 11 financial centers in the European Union, aiming to promote the creation of a common EU financial market in cooperation with the member state. Thank you for our partners this time. Again, we are ahead of London for 1 hour. Let's make the best of it. Ladies and gentlemen, in our financial market, derivatives play a very important role, but they also do bring certain risks, which were highlighted during the 2008 financial crisis. In 2012, the EU adopted the European Market Infrastructure Regulation, known as EMIR, which in particular requires all standardized OTC derivative contracts must be centrally cleared through CCPs. The EU clearing system became subject to intensive discussion following the UK's withdrawal from the EU. Some of you may remember that the UK went in front of the European Court of Justice because the ECB wanted to have the CCP under their regulation and oversight. They won the case, but ever since the Brexit, they no longer the European Court of Justice is applicable. We all know that the EU initially set a deadline of June 2020 for its banks and fund managers to wean themselves of London's clearing houses. But early this year, they announced a 3-year extension to the equivalence regime. CCPs and their interlinkage to the financial system are systemically important. That is why ESMA established the CCP Supervisory Committee in January 2020. So where do we stand, especially against the background of Brexit? Today, we are very honored to have the chair of the CCP Supervisory Committee of the ESMA, Mr. Klaus Löber, as a speaker, talking about the evolving framework for clearing in the EU. Klaus Löber took up office in December 1st, 2020, and is serving a 5-year term. His areas of responsibility encompass in particular the management of the risk of CCPs established in third countries may pose on the EU. Prior to his role, Mr. Löber was head of oversight of the European Central Bank in charge of financial market infrastructures, payments instruments, and schemes. Earlier positions include stints at the Bank for International Settlement, the European Commission, Deutsche Bundesbank, and private practice. Mr. Löber regularly publishes and lectures at university. We are very, very happy to having him today. Dear audience, please feel free to input your questions during or after the speech in the Q&A section in Zoom. We will record the video for the speech today, and it will be published on the FMF website tomorrow. And we would like to draw your attention here, please, to do not publish or use any quotation of today's speech without getting prior permission. We thank you very much for your understanding and cooperation. Mr. Löber, the stage is set and it's all yours.
Many thanks and good morning, everyone. Indeed, it's a great pleasure and honor for me to join you here for this event, both that it is organized in Frankfurt, but also that it has a European perspective. For me, it's a bit a walk down memory lane because I started my professional career in Frankfurt as a lawyer with some of the international law firms during the time of the merger frenzy when they changed their name every few weeks. So that was back in the 90s, and I actually looked for a bit more stability, as it was just indicated. I joined Deutsche Bundesbank as part of the team that was negotiating monetary union. So again, a project to enhance and deepen European integration, and we all know where we stand with this particular project. Of course, since then I have moved on and worked both in European and international institutions. So I have tried to have a focus which is not particularly focused on a specific national area. But let me just see, before I give you an overview a bit about the clearing landscape, and in particular the role of ESMA, of the CCP Supervisory Committee, I have prepared a set of slides, and I just wonder whether we can put them up as a background. Brilliant, many thanks. So before going in the details, and I'm particularly grateful for the introduction by Mr. Fed, who has been reminding of some of the original reflections, setting up European legislation to regulate clearing and central counterparties in particular. That is a recognition, because the clearing landscape is at the heart of the international financial markets, but it is an area which is in perpetual evolution, led by forces such as the needs of market participants and their preferences, but also by technical innovations, by also to a certain degree regulatory changes that have a bearing on the way clearing services are being offered and provided both domestically and cross-border. Frankfurt is a focal point to this particular evolution and to these structural changes. And that's why I'm very pleased to address you here in this setting to talk about the supervisory and regulatory framework for CCPs in the EU, how it has evolved, and what may still happen in terms of adaptations to cater for ongoing trends and changing risks. Let's move to the next slide, please. And let me provide you with a bit of background on the CCP Supervisory Committee, because I perfectly acknowledge this is a body which, in the concert of European institutions and bodies, is still relatively unknown. It's also still quite recent. As Mr. Fed mentioned, it was set up only in 2020, and it is part of a process of reviewing EMIR, the European Market Infrastructure Regulation, which is the foundation of EU law supporting the provision of derivatives clearing and clearing services by central counterparties. The legislation itself originally was a response to the great financial crisis of 2007-2008. And its main ambit at that time was to address perceived weaknesses in the robustness, in transparency, in risk management around the clearing of OTC derivatives, but also to a certain degree exchange traded derivatives. This is a recognition that the key players in the management of risks in the clearing space for derivatives are central counterparties, financial market infrastructures which are systemic by nature, as they concentrate substantial counterparty credit and market risks. And they do so by providing sophisticated risk management, risk mitigation, but in doing so, they not only concentrate the risk, they also neutralize it in case of defaults, in case of stress events, and this mutualization is across its range of participants. So it may affect the full range of clearing members, participants in the CCP, which are normally the major banks. The review that has led to the creation of the CCP Supervisory Committee is a response to another development, which was basically triggered by the advent of Brexit. And as a result of Brexit, some of the major CCPs providing clearing services in what was then the scope of the EU are now offshore. And whilst this has led to the migration of a particular part of business from being domestically EU to cross-border from an EU jurisdictional perspective. At the same time, it has also led to reflections on how the supervisory framework in the EU can be enhanced, how you could contribute to a robust capital market union, of which CCPs are an essential piece. So the CCP Supervisory Committee was set up in response and as part of this conundrum. And it is a quite original setup, I must say. It is inspired to some extent by the reflections and the design of the single supervisory mechanism that was placed with the ECB for bank supervision. But at the same time, of course, it has a different scale. It's much smaller, and also the constituency, the CCPs, are much smaller in number than the banks. So it is established as a body with ESMA, but with differences in governance and decision-making from the normal ESMA processes. In particular, you can see this by the composition. Unlike most EU bodies, it does not encompass representatives from all member states. It only encompasses those national competent authorities, the supervisors of CCPs in the 12 EU member states which actually supervise CCPs, which have CCPs established in their jurisdiction. It also contains, in addition to the supervisors, central banks in their role as central bank of issue of relevant currencies that are being cleared in the CCPs. These are not all EU currencies, but they encompass those which are widely traded on the financial markets, certainly the euro, the Swedish krona, the Polish zloty, and a few others. In addition, and again, this is kind of a novelty, it also encompasses 3 independent members, 2 independent members serving on the committee and a chair. And I have to note that my own role as the chair is a kind of a hybrid. I'm a staff member of ESMA, but at the same time, I'm supposed to work in an independent fashion. And I'm, like the 2 independent members, are accountable directly to the ESMA Board of Supervisors and the European Parliament, which is an intriguing situation for those of you who know to deal with open hearings in the European Parliament. Just to note that when the CCP Supervisory Committee was set up, it was in the middle of COVID. And that, of course, meant that the setup of the committee did take place in a fully remote manner during lockdown. I cannot really recommend to set up a new function to bring into place new staff, new process, new procedures in a completely remote environment. It was quite a bit of a challenge, and I'm very happy that now we have been able to move back to some form of presence in Paris, allowing the team actually to interact directly and also again to engage directly with stakeholders, which is a key part of establishing a good relationship here. But another aspect which was intriguing in the setup, of course, was that the Supervisory Committee didn't really have time to get into motions, because already at the outset, it was faced with the implications of the major shock that was caused by the impact of COVID-19, in particular March, April 2020, which of course had major repercussions for CCP stability through increased volatility and liquidity strains. And as you all know, now as we face the implications of the deplorable Russian invasion of Ukraine, again, we are in a situation of a major shock affecting the resilience of the financial markets. So that actually was a real-life stress test for the Supervisory Committee from the outset. So how do we go about performing our mission? The CCP Supervisory Committee actually has a double mission. It is meant to promote supervisory convergence for EU CCP supervision, and as regards third country CCPs, it is entrusted with the recognition, the monitoring, and in the case of the most systemic third country CCPs, direct supervision of those CCPs. Of course, that's not all. There's a considerable amount of work being dedicated to the usual EU rule setting. So the CCP Supervisory Committee is instrumental in preparing draft technical standards for CCP supervision, and more recently has also been entrusted with the formulation of the technical standards for CCP recovery and resolution. Again, a key piece complementing the framework to support the overall resilience of the clearing space. Perhaps let's move to the next slide and take a slightly deeper dive into some of the core functions. Let me start with the EU angle. And it is worth recalling that within the EU, there are currently 14 CCPs authorized under EMIR. These 14, of course, are supervised, and as I mentioned, they are located in 12 EU member states. The CCP Supervisory Committee is meant to leverage here on the financial market expertise that does exist at the level of the national authorities, and to promote a common supervisory culture and an application of the rules, thanks to a wide array of tools and mandates that have been brought in by EMIR 2.2, so the review of EMIR, in terms of allowing to review what is being done at the national authorities, to see whether there can be an enhancement of the common application, whether there are certain recommendations or opinions to be provided. More specifically, it means that national authorities have to submit draft supervisory decisions for review by its peers in the CCP Supervisory Committee. For example, when it comes to the authorization of an extension of service of a CCP. The Supervisory Committee may then decide to adopt recommendations in order to ensure a common supervisory outcome and a level playing field inside the EU. There are also some particular actions which are considered to be of such critical importance, like the risk models or risk parameters of CCPs, that they are subject to a requirement of validation of significant changes to these risk models by not only the national authority, but also by the CCP Supervisory Committee, thus having a direct decision-making power at the level of the Supervisory Committee and the ESMA Board of Supervisors for these particular changes. This really allows the committee to have a systemic and cross-border perspective on CCPs across all EU CCPs, to make sure that there is a common perspective, a common degree of ensuring resilience, and to avoid any leveraging or race to the bottom by differences of application of EU law. Actually, the CCP Supervisory Committee has been moving to issue supplementary guidelines and recommendations in a few fields, and in particular, it has been working on developing a forward-looking risk-based supervisory perspective to address ongoing and emerging risks. Perhaps a very practical example here, and I'm afraid I have to tie in again with the deplorable unlawful invasion by Russia. Again, during such a situation of shock to the financial markets, CCPs generally performed their critical services without any significant disruption. That, again, perhaps is a testament already to the increased resilience supported by the EU legislation, but also by international standards that had been developed after the great financial crisis of 2007-2008. But of course, whilst the EU CCPs have been able to handle the significant increased size and frequency of margin calls, the volatility of prices that have been affecting a number of products, in particular in the derivative space, in the energy, in the commodities segment. Also, it was noticeable that the clearing members generally were able to meet their margin requirements. However, there were liquidity strains, in particular at the level of non-financial institutions and in some market segments, natural gas, some metals, that were noticeable, as were some significant concentrations of positions across certain clients and clearing members and across CCPs. Again, the particular design of the CCP Supervisory Committee that has a perspective across CCPs has clearly contributed here to enabling the EU to have a comprehensive and holistic perspective on the build-up of such potential stresses across different market players, which may have been more difficult if you would have had a purely national perspective on this. But there are also some more general tasks being performed that really support supervisory convergence and resilience inside the EU. And I just would like to point out two particular areas which, again, are quite significant and the most visible product of the Supervisory Committee over the past 2 years were the CCP stress test exercises, which are conducted regularly. And we are currently in the middle of the 4th EU-wide stress testing exercise. And of course, over time, we have been expanding the areas that are being looked at, credit risk, concentration risk. One particular novel aspect that we have been looking at in the current exercise was operational risk. In particular, to look at the increased reliance on by CCPs on shared third-party providers. Again, that is a reflection, for example, of the use of cloud service providers as an oncoming issue of relevance to make sure that there is no undue impact of such use of third-party providers on the resilience of CCPs. We have also been picking up some lessons learned from the COVID crisis by organizing a peer review of the assessment by the national authorities of the business continuity arrangements of CCPs working under remote working arrangements. Again, that was a quite interesting exercise to see the differences in the speed and the scaling up of remote working arrangements across different CCPs. Another example that I would like to pick up, again, picking up on the experience from the COVID impact, was a currently ongoing review by the Supervisory Committee of the issue of procyclicality of margin calls. Again, we have been seeing some spikes in margin calls, significant and considerably higher in some instances, even compared to the Great Crisis of 2007-2008. So we have been looking at the existing tools under EMIR, which are already quite sophisticated, to see whether certain margin models may have behaving in exactly procyclical manner during the market developments because of COVID-19, and to see whether there may be a need to calibrate and balance some of the existing tools to be applied whilst still permitting CCPs sufficient flexibility to act, and without preempting international work to further harmonize some of those tools. Again, that is an exercise which is currently after a public consultation and finalization. We will do a bit of fine-tuning here again to review our findings in view of the more recent implications from the Russian crisis. But again, I expect that we will come up with our proposals here later this year, again, showing the responsiveness to ongoing changes in the clearing landscape. Finally, I would like to point out some forward-looking work that we are conducting, which is in the area of climate risks. As we have been conducting some truly innovative work trying to better understand how climate risks impact CCPs. So far, we have been identifying 4 types of climate risk which may impact CCPs in a public call for evidence, ranging from physical risk, the traditional impact, for example, of extreme weather events, to rapid change risks if there's an abrupt correction of risk perception by investors, for example, in relation to certain types of brown assets, but also more long-term implications like business model risk, if there are certain asset classes which become more or less used with the transition to more renewable products, and also collateral risk, where climate change transition could affect collateral posted by clearing members in terms of suitability or legal requirements. So that is again something where, based on the market feedback that we have been receiving, we may be looking to integrate climate risk in our future stress test exercises to make sure that CCPs are adequately prepared for these type of risks. However, as I mentioned, the focus on EU CCPs is only part of our mandate. And if we can move to the next slide, please. There's also the recognition that third country CCPs may have a significant impact on EU financial stability or the stability of individual member states. And as a result, EMIR 2.2 established a proportionate and risk-driven approach to the recognition of third country CCPs. So the permission to third country CCPs to offer clearing services to EU participants, EU clients. And that is something where the proportionality in particular is reflected in an approach which is called tiering, where CCPs are classified according to the level of risks they pose to the financial stability of the EU. Again, this is a comprehensive exercise, and we have, in the course of the last 12 months, reviewed the existing recognitions of 25 third country CCPs that were already recognized by ESMA under the old EMIR framework, and we have tiered them to see whether they are either of less systemic importance or of a higher systemic importance, and accordingly have adjusted our recognition decisions, again, to enable them to continue access to the EU markets based on the principle of deference to the supervision by the home authority. And that entails the need to also engage very closely with the home supervisors of the third country CCPs. We actually had to negotiate about 20 MOUs, Memoranda of Understanding, with the home supervisors to make sure that there is a sufficient degree of cooperation and information exchange to allow ESMA, to allow the EU to understand the risks posed by particular third country CCPs and the services they offer. We also have a number of applicant CCPs in addition. I think it's about almost 20 that also want to profit from this, which are in a waiting queue, but where the process of recognition by ESMA is dependent on equivalence decisions that have not yet been granted by the EU Commission. So if and when there are further equivalence decisions issued, we may be able to also recognize further third country CCPs, again subject to an assessment as to their compliance with the requirements under EMIR. However, this is the normal practice for third country CCPs, which are deemed to be of less systemic importance for the EU. There are a few CCPs which, due to the size, volumes of their services being offered, have a particular critical status. And these are two CCPs which are located in London. This is LCH Limited and Ice Clear Europe, which have been, because of their systemic relevance for EU financial stability, have been allocated what is called in EU jargon a tier 2 status, which implies that these two CCPs are subject to the direct supervision by the CCP Supervisory Committee and are also directly subject to an ongoing compliance with EMIR. That is a quite strong approach. It's not unique globally. You find it in a few other jurisdictions as well. The US, for example, has taken a quite strict approach also to the provision of clearing services by third country CCPs to US banks. So we have been drawing a bit of inspiration from those approaches, but still it means that we have to engage and undertake our direct supervision in parallel, but in close cooperation with the relevant home supervisor of those two CCPs, which is Bank of England. So that is again an engagement which we have been building up over the past months and years to make sure that whilst due recognition is being given to the particularities of EU financial stability, the CCPs are not unduly burdened with duplicative or even conflicting supervisory expectations. What we do here, however, is true supervision. We conduct annual reviews, we request regular information from the CCPs, we may conduct investigations, potential enforcement actions, and we also validate significant changes to risk models as we do for EU CCPs. So that is something which is quite comprehensive. We also include the Tier 2 CCPs in the annual ESMA stress test exercises together with the 14 EU CCPs. Why direct supervision? Again, as I mentioned, the usual principle in cross-border collaboration is deference. So the reliance on the conduct of supervision by home supervisors, and provided that such supervision is based on comparable standards. However, for certain CCPs, the situation may be specific given the particular critical role such CCPs play for the EU financial markets, its financial stability and monetary policy. So that is why here deference has not been seen as being sufficient to cater for concerns, for the needs to allow the EU to protect its financial stability by pure deference. Let's move to the next slide and take, in the last part of my overview, a deeper dive in what the position of the UK CCPs means and what a potential direction of travel here may be. So in view of the particular significance of the role of those Tier 2 CCPs in the UK, EMIR also requested the Supervisory Committee to conduct a review of the existing recognitions, a task which we have been concluding within the very tight time frame that was allocated, and we have been concluding this comprehensive assessment by December last year. Those of you who are interested can find the assessment on the website of ESMA. And what we actually have been doing is to look at the situation that we are facing, because whilst the current UK rules are still based on EMIR, it is acknowledged, and actually the UK government has already indicated they might start to diverge in certain aspects from the existing EU regime, and also the application of the rules by UK authorities may not necessarily give due priority to the EU financial stability needs in case of a major crisis. And this is not purely hypothetical. We have seen in the past instances, some of you will recall the issue of the Icelandic banks, where indeed there may be, in case of a severe crisis, priority given first to some home concerns before the interests of third countries are being considered as well. So EMIR 2.2 was actually a reaction to this. And there is a significantly enhanced role now of ESMA, of the Supervisory Committee, towards those third country CCPs, but there are also limits to what you can do by remote supervision. over an entity which is not located in your jurisdiction. So that is why under EMIR 2.2, the Supervisory Committee was mandated to assess whether a systemic third country CCP or some of its services of such substantial systemic importance to the EU that the CCP should not be recognized anymore to provide those services or activities. We have been conducting this exercise, and you may guess, of course, this is against a significant political backdrop. We have been doing this on a purely risk-driven assessment basis, based on a methodology which we developed and published, so to be perfectly transparent about the approach we have been taking, about the elements considered as part of this assessment. And at the end of last year, we concluded the assessment with the finding that not the CCPs as a whole, but 3 particular clearing services provided by the Tier 2 CCPs are being of such substantial importance for the Union or one or more member states that they require particular attention. And this is in particular the swap clear service by LCH for the euro and the Polish zloty, and the CDS segment and the short-term interest rate services of ICE Clear Europe for euro products. However, we have also been asked by EMIR not just to conduct this risk assessment, but to also conduct a comprehensive cost-benefit analysis as to what the consequences of a derecognition may be. And this second part of the assessment concluded that at this point in time, the costs of derecognizing these clearing services would outweigh the benefits. And therefore, we did not recommend to the Commission that these services should not be recognized anymore. Sorry, this is a double or even triple negative. So basically we said at this point that derecognition is not the appropriate answer. And again, I would encourage you to take a look at the assessment as to some of the details which you may find quite intriguing. However, this is not the end of the story, because at the same time we emphasized that our assessment found that there are significant risks and vulnerabilities in connection with the continued recognition of these clearing services, in particular when it comes to times of stress. And we have been proposing a number of risk mitigating measures that should be considered by the relevant bodies to address the risks stemming from the current exposure levels of EU participants to these clearing services. So perhaps to get to the last slides to see what the next steps may be. Thank you very much. So based on the assessment by the Supervisory Committee and endorsed by the ESMA Board of Supervisors, the European Commission actually decided to temporarily extend the existing equivalence decisions by 3 years. And this is not all, because equivalence is only one part. So also ESMA, a bit less visible, extended the recognitions, again, temporary for the same period until June 2025. But in parallel, the Commission issued a targeted consultation on a review of the central clearing framework in the EU. So clearly acknowledged the need to reconsider the framework under which clearing services are being provided to the EU and within the EU. And on the side of ESMA, we strongly welcome the breadth of the measures considered by the European Commission, trying to look at multiple avenues for reducing the exposure levels to UK CCPs, which are the major source of risk identified by the ESMA risk assessment, whilst also aiming to make the EU clearing system more attractive. That is less a risk-driven issue, so it's less for ESMA, but we also believe this is part of the bigger picture to make sure that there is a sufficiently developed and attractive offering of clearing services within the EU. Again, we have been responding to the public consultation of the Commission, and ESMA identified a number of measures which we find more promising. And I would note that there's probably not a single measure which would provide the solution to all the issues identified. But we also outlined a number of areas where further work or reflection may be needed, in particular as regards measures to make the clearing ecosystem more attractive and to reduce the EU dependence on the substantially systemic UK CCP services. Just to flag very shortly, and I can encourage those who are interested to look a bit more closely in both the EU consultation and the ESMA response. There are a number of measures which could be considered to help building liquidity in the EU clearing space. And these may be considerations around the scope and implementation of the clearing obligation. As you know, there is already an inclusion of pension funds within the clearing obligation starting as of June 2023, but there may be also other aspects supporting this, such as the provision of voluntary central clearing by certain public entities in the EU CCP that may contribute to liquidity of the EU clearing space. However, there may also be a need to look at potential incentives for EU clearing participants to reduce exposures. And here we believe that there's a significant amount of considerations needed to look at a variety of aspects, including the potential prudential treatment of clearing members' exposures, the potential reduction targets for exposures, or the provision of active clearing accounts at EU CCPs, or probably a combination of that could help to further build liquidity at EU CCPs. However, these measures require a careful and thorough assessment of the risk and benefits of each of those elements, or the combination of those, to ensure that the cost of these options are not disproportionate to the exact benefits. And in particular, there are issues to make sure that these measures do not create an unlevel playing field for EU participants as opposed to third country banks and clearing members by potentially making the provision of these services by EU banks less attractive. There's also, of course, always the issue that if there were a shift from the UK Tier 2 CCPs, it is not taken for granted that a move may come to the EU. It could also move to other third country CCPs that are already authorized to offer clearing services. So again, there's a variety of elements that should be looked at as part of these developments. Lastly, I also would like to recall this is not just a matter of the direct participants in CCPs, which are usually the major banks, but there should also be considerations on the role of clients, the users of clearing services offered by the direct participants in CCPs that are part of the overall equation. And that is something which again requires a bit more reflection, as also the Commission consultation has acknowledged. Lastly, on the side of ESMA, we will of course also continue a close dialogue with market participants and central banks to understand better the implication of existing settlement arrangements and liquidity management of CCP financial resources, because again, this is a key element of the potential attractiveness of EU CCPs. However, this is just the area of incentives to reduce exposures and to enhance the attractiveness. The Commission is also looking in the second part at measures to strengthen and streamline the EU supervisory framework. And of course, this is an essential element because, as I would like to stress, if there are indeed risks successfully shifted from UK CCPs to EU CCPs, and if those risks reach a magnitude that is compared to what we now see in the UK, also reflections are needed on the most appropriate setup of supervision inside the EU, because again, CCPs, as I said from the outset, are not domestic by nature. They spread risks across the full range of participants that are in there, and that clearly is not limited to a single EU jurisdiction. It has implications for the full EU. But again, there's a need to see how the current system can be more effective and reactive to those EU-wide risk implications. What is needed in the short term is to streamline the existing supervisory procedures under EMIR and to avoid duplicative and burdensome processes, in particular to shorten time to market, where currently there are some disadvantages in the EU compared to other jurisdictions. Again, ESMA has been making some concrete proposals here and will continue in the dialogue to ensure that we can compete here globally. Given the time, and as I hope there will be some questions or reactions, let me just conclude that as you can see from this, we are at this point still at the beginning of the process. And on the side of the Supervisory Committee, we look forward to engaging closely with the EU Commission, with other relevant institutions and with the market participants to continue adapting our regulatory and supervisory framework to an ever-changing clearing landscape and to safeguard the financial stability in the EU. As you can see, I try to bring a bit more closer a typical EU construct to answer these issues. It's complex, but at the same time, I hope I have been able to show it has been shown its added value, in particular as it has been exposed to real stress tests already in the short time of its existence. So again, I think we can make a change here for the attractiveness of the EU financial markets, in particular, if also the policymakers and the industry plays a role to make the EU capital markets sufficiently deep and to develop an attractive range of services supporting the market needs. Thanks a lot for the attention, and I hope we will have a bit of a discussion now.
We absolutely will. Thank you very much, Mr. Löber. That's been absolutely insightful. And I think we should all thank you for contributing to the financial stability of our system. Clearly, in 2008, the financial industry has been part of the problem, whilst during COVID, we've been part of the solution. And now it very much looks like, when we look at either the war in Ukraine or the sustainability transformation, the financial industry even becomes the solution, both with enforcing sanctions and the transformation. So it's been very, very insightful, very important. Let me start with, while a number of questions come in, with two things that I find intriguing. There is a national monopoly in CCPs. Has that played a role, that you basically were looking at it, that stability, financial stability should rather have that burden on various shoulders rather than sustaining a natural monopoly, number one? And the other question is equivalence. Equivalence was post-Brexit intensively discussed as, and sometimes described as, a rather fragile construction. On which to have such an important element of the financial infrastructure. So what's your view on those both? Is equivalence a long-term viable solution, or and should systematically be avoided that there are monopolies?
These are two intriguing questions. And again, we could probably spend the full morning on answering some of those. But let me start with the national monopoly question. Actually, CCPs are not what I would call a natural national monopoly. And you have to differentiate here a bit. Of course, there are some parts of their services which are clearly geared to support a particular market. This is in particular true for the clearing of exchange-traded derivatives. But there are other segments which are cross-border, even global by nature, because again, CCPs leverage economies of scale. They provide netting opportunities by concentrating significant amounts of derivatives clearing in a single place. And this is the case not just now with the two tier 2 CCPs I've been mentioning. There are a couple of globally active CCPs, some inside the EU, not too many, to be honest. Some are in the US. So there is room for CCPs that serve for particular segments not just a narrow geographical range. However, as you said, there are questions around what this means for supervision and for national support. And again, there's always the question of ultimately who provides the backstop if something goes wrong. And this is a fair question. I'm not challenging this. And of course, there is a certain role to be played by the jurisdiction in which a CCP is established. But again, as I hope I emphasized, CCPs are risk neutralizers. So they do not necessarily have the losses in the end falling at the CCP itself. It is spread across the full range of participants. And if those participants, if the banks are coming for a globally active CCP from a wide array of EU jurisdictions and even global ones, you need to think about different ways to supervise that risk and to cooperate and coordinate across authorities. And again, we have been trying to provide first part of this answer for the EU side with the Supervisory Committee, but this is work in progress. And we will have to continue to have further discussions on what the best supervisory approach to this is. On the equivalence, again, that is another interesting question as to what role equivalence has and to what extent this is having a political dimension. Perhaps we are in a somewhat specific situation here in the clearing space as opposed to other market segments where equivalence, like for example on the trading side, clearly is an issue that mostly has a market dimension. For clearing, again, for the economies of scale side, and also because equivalence does not mean a pure deference. We have the tools and the means to also have a direct responsibility supervisory over third country CCPs which are in an equivalent environment and which are recognized. The situation perhaps is a bit different. But again, this is for the Commission to consider the overall framework of equivalence. I'm happy to defer to my colleagues here about the specific reflections.
Excellent. You mentioned earlier on that liquidity risk is an area where you look in particular. And I recall having looked into the industry in the beginning of the Brexit time, that one of the things that struck me is that some CCPs do have banking license where others don't. And with the banking license, obviously goes account with the central bank and the ability in times of crisis to draw liquidity. How important is that aspect in your risk assessment of the respective CCP?
Again, that is a long-standing and intriguing question. To be perfectly blunt, CCPs are not banks. And to the extent that they provide perhaps certain ancillary banking services, it's a really ancillary part of their business. The core part are risks which are specific to infrastructures and CCPs and do require a very specific type of supervision. But that is more on the supervisory dimension. Of course, the access to central bank liquidity is reliant on the access conditions by central banks. And in the case of the Eurosystem, there are specific preconditions for an institution to access those. Again, the bank license does help here. I would not try to ask the central bank here to follow the ESMA views, but of course, what is important from my perspective is that there is a level playing field for EU CCPs when it comes to accessing central bank liquidity. And that is something which I hope will be part of the considerations now in this exercise as well.
Mm-hmm. Here's a question from the audience. EU published targeted consultants on the review of the central clearing framework in February this year. The consultation period is finished now. Can you give us already some insights and what feedback you've got and how that eventually will be integrated?
Well, at this point, we are in the same position as those who have been asking the question have been providing input to the European Commission. Like the market participants, ESMA has been providing feedback on the Commission consultation. Of course, we are in close dialogue with the colleagues, but the ball here at this point is clearly on the side of the Commission. I understand there has been a very lively response to the consultation, and that is good because it is really crucial that a wide array of different perspectives and different angles are being brought in here. But at this point, I'm not claiming any privileged information as to the thinking of the Commission on what the direction of the answers is and how it will be reflected.
So we should stay tuned there. And here is another question from the audience, which you eventually may answer very easily by wipe it away, or very difficult. It's about crypto asset clearing. I mean, clearly it's not in the focus, but what regulatory trend do you see? Do you foresee that these will become part of your work as well?
Absolutely. And I have been focusing now a bit more on the current framework and the particular issue of the EU clearing evolution and the EU implications. But the technological change is a key part of our attention. And I mean, it is something which is currently already strongly going on. Of course, we see already the clearing of certain products which are referencing crypto assets by licensed CCPs. And to the extent that this refers to indices and the like, it's not much different also in terms of risk profile from some of the existing products. A different story, of course, is the clearing directly of crypto assets in their various shapes and forms, where the risk considerations may be significantly different because of volatility. But more specifically, I expect a major impact here when it comes to clearing models, the way clearing services are being offered, in particular by some new market entrants. And there are two-pronged approaches. First, you already see now some newcomers trying to enter the field of traditional clearing services, which have significant funding behind them. And in particular in the US, you have some very prominent names here who are currently trying to get regulatory approval. It's only a matter of time that this is happening similarly in the EU. We need to be prepared, and we need to look at whether the existing framework is adequate here. An even bigger challenge comes from the offering of certain crypto exchanges who are offering entirely new clearing models, which are not only perhaps a bit more direct, like some of the incumbents, like some of the newcomers I just mentioned, but who actually stepping away from the central clearing model that we have been focusing on now for the last 20 years by moving to a more decentralized clearinghouse style approach, or even not any kind of traditional form. Again, we need to be very attentive, and we need to look at the regulatory parameter. Is it possible to address, in particular, the potential concentration of risks within those offerings in an appropriate manner? This is part of the reflections that we now have. If not part of this targeted review, there's also the regular EMIR review to come in 2024. So at the latest, at this point, we will not escape the discussion.
Mr. Löber, a sort of a twin at the time when 2008 we had the financial crisis, and thereafter the legislation on EMIR and derivatives clearing was the legal entity identifier, that the numbering agency, that each and every of those derivatives got their particular number. So it was more visible where in the system the risk has been. Is actually technology, is blockchain, is crypto assets making that completely technically obsolete?
I still need to encounter a technical innovation which makes some of the existing problems redundant or obsolete. But it may facilitate certain issues. But even with DLT, for example, what it will facilitate certainly is the integration of services. And another potential evolution we have not touched on is to see whether the traditional segregation between trading, clearing, and settlement may also blur a bit in the future because of the technological abilities to integrate these services on single technical environments. As for the transparency aspect, again, developments like the LEI have been instrumental to facilitate the understanding of the buildup and concentration of risks, but we still need to work further on this. And again, technology may only provide a partial answer here as well. Again, one of the immediate lessons I would draw from what we have seen now in the commodities markets, for example, in the Russian crisis now, is that there is a need to enhance transparency of positions across CCPs, client clearing members. We are not yet there. So any incremental enhancement here coming from whatever source is certainly welcome.
Yeah. So the truth remains that the biggest room in the world is the room for improvement. Thank you very, very much, Mr. Löber. It's been a very insightful start in the day. You had a wonderful, insightful, a whole lot of information for us. And ladies and gentlemen, as our event today draws to a close, I would like to flag that our next food for thought will be a bit special. It will be kind of a food for thought plus, because it will last 1.5 hours, because we have 2 speakers. The first is Mr. Jörg Eigendorf, the Global Head of Communications and Sustainability at Deutsche Bank, and Mr. Damien Hales, the Partner of Financial Services Risk Advisory at Deloitte UK. And we'll discuss the new role of the C-suite job in sustainability, to have the Market Chief Sustainability Officer. So once again, thank you very much for tuning in. Thank you very much, Mr. Löber. We're very grateful for your stabilization work, and we'll feel safe in your pair of hands. Thanks a lot, and ladies and gentlemen, a very, very good start in the day.
Thanks as well. Have a good day.
Thank you.